What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is April 24th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to discuss about what may be the most important topic for us to focus on in relation to crypto markets in the year of 2022. And it's luckily something that I think is going to serve as a major catalyst for price to break higher that no one is talking about in the crypto market right now, because it has to do with the macro environment. We're going to talk about a lot of different things in today's video that have to do with the Fed, with the bond market, some things that you might not commonly look at when it comes to crypto. But I promise you all, if you can stay through it, it's going to be probably one of the most valuable videos that you could watch here in Q2 of 2022 and beyond. And outside of that as well, we've got a sponsored review of the Radix protocol later on in the conversation, so we'll dive into that later on. Now, let's go ahead and kick things off, guys. Now, I want to start off here by talking again about what we've been seeing here in price. You all know we've been talking about this elevation of higher lows and generally either higher highs or consistent highs on Bitcoin's price. We've been seeing a similar trend here with Ethereum over the past few months here. Higher highs over time and consistently higher lows. Now, it's one thing for us to look at price and start feeling sentiment, but I want to go ahead and dive into something completely separate from crypto that could signal why we're seeing this. Why are we seeing higher lows in an environment where people are concerned about the moves of the Federal Reserve? And if you don't know what those moves might be or those decisions, we'll dive into that a little bit later. And also, how could Bitcoin and Ethereum be doing so well in a period of heightened inflation? How could we be seeing this in a period of time where people are concerned about global geopolitical conflicts, shifting world powers? How could Bitcoin and Ethereum be doing well? Well, I want to go ahead and focus on a market that doesn't get talked about a lot, especially amongst crypto traders. And this is where my macro backend, or my background for that matter, starts to come in. I want to take a look at something known as the U.S. 10-year yield. Okay, now this is the 10-year yield for government bonds in the United States, U.S. Treasuries. Now, for those of you who don't know what a treasury is or a government bond, I'm going to give you the really quick, too long to not read definition. Bonds are IOUs, just as if you were to take out a mortgage to buy a home. They are a form of debt, government debt, and it is a promise from the government in this case, not only to repay the principal over time, so you can materialize on your treasuries, but on top of that as well, to earn some form of yield on top of it. It's aimed as a fixed income asset to help you generate passive income to not only hedge against inflation, but hopefully grow your wealth over time. Now, bonds used to be able to not only hedge against inflation, but they used to actually give you a yield that really you could take to the bank in this case. That was really good, right? Well, bonds have been this kind of baseline way that large money and institutions have been able to hedge against the excessive money printing of the past decade or two. It doesn't do a great job of it, but it is where the vast majority of wealth that's not parked in bank accounts is parked in the world. And it is a multi-trillion-dollar industry, tens of trillions of dollars just in the U.S. Treasury market. And if you're talking about global markets, you're talking about tens, if not hundreds of billions of dollars when it comes to fixed income markets or global debt, right? So I want to go ahead and point your attention to this chart here. This is the 10-year yield. And as you can see over time, and generally if we really zoom out here, the 10-year yield has been declining over a long period of time since back in the 80s. And this was back when really, again, this was the ending of the symptoms here of the last inflation wave here, where Paul Volcker, who was the Fed chairman at the time, had spiked the federal funds rate. He had basically increased the cost to borrow new money or generate new credit in the economy. And this not only put the economy into a necessary recession, I'll explain why in a moment, but he was able to do something that many people thought was impossible at the time. Back in the 70s, when there was rampant double-digit inflation month over month, he was able to curb inflation, rebuild trust in the dollar and in the global economy for that matter. Now, we can see here, since back then, because he raised the federal funds rate, we can see that bond yields in this case, or treasury yields, spiked up with it. Since then, the federal funds rate has been on a consistent decline into a more stabilized economy that had escaped that recession and continued to grow. But as we went in towards the final decline here into March of 2020 during the pandemic, This took us down to rock bottom, a 0.5% annualized yield, the lowest rates we had seen since as far back as decades ago, back during the early 20th century in this case, right? So this is really, really important stuff to understand. All the while bonds might seem boring, right? It's not an altcoin. It's not some crazy trend in crypto. It's not the metaverse or NFTs. It's important to understand why this is significant. This was the lowest range we had seen in nearly a century for the US 10-year yield, a market where there are tens of trillions of dollars of wealth stored in. Now, the other important thing to understand here when it comes to looking at the 10-year yield is seeing what's happened here since March of 2020. We have gone from 0.5% in the returns on these bonds or these treasuries up towards 3%. This is the fastest year-over-year acceleration we have seen for the 10-year yield in a very long period of time. The yield has gone up just in the past few months. That's the reason this candle is so significant. In the past 3 to 4 months here, we have seen the 10-year yield go up 91% in returns. That means that if you're holding a 10-year bond in this case, or 10-year treasury note, you are getting nearly double the yield you were getting just 4 months ago. Now, let's just go ahead and scan the chart here. That's more of a leap up than here back in January 2013, and back here in January 2009, back here in January 1999, and practically any prior year before. And if you take it to the log chart, it really starts to show you what's going on here. We are seeing potentially the reversal, the first significant bear market for bonds in a long period of time. Now, I understand you're wondering why you're saying bear market, Nick. The yield's going up. Well, there's something that inverses the yields trend, and that is the actual value for the bonds. Let's go ahead and take a look here at the US 10-year, right? The actual cost of the bonds in this case. We've seen a significant decline since back here in March, breaking out not only above the general trend here we'd seen for the last decade, where bonds in this case usually track between a consistent range, not only having the exacerbated blow off top, but having a breakdown below the trend. Bonds are selling off like they're going out of style. We're seeing the same here with the 10-year yield for the Great British, in this case, or GB in this case, or the UK bonds in this case. I always mix that up. The UK 10-year government bond yields, right? Leaking out of a major descending wedge here, starting to break out higher. Back here it was around 0.2%, now trending towards 2% in the yields. The only anomaly here I'd say, and I think it's something that's wrong with the data here, is the actual bond price here that we're getting on TradingView. But you'll start to see the similarities directly when it comes to the other bonds across the world. The Deutsche bonds in this case, the government bonds for Germany, right? We can see here spiking up from not only negative territory, but now finally entering into strong positive territory, a level we haven't seen since August of 2014, nearly 1%. And look what's happening to the actual bond prices, selling off, dropping like a rock here, a true falling knife here, where week over week, month over month, we are seeing the demand for bonds declining. Take a look at the French bonds in this case, France government bonds, right? Any kind of trend line you could have drawn here for the yield here has now been broken. It is now spiking up near 1.5%. It was down in negative territory, just like the government bonds for Germany. And take a look here at the actual bond price, dropping to its lowest level in nearly a decade. And this is after the central banks of the world, from the ECB to the Federal Reserve to the Bank of Japan, any kind of central bank you could think about, had gone through decades of purchasing these bonds, otherwise known as quantitative easing. You've probably heard about this before. In order to stimulate the economy, they bought tons and tons of government bonds, therefore exchanging for those government bonds cash, new money, for governments to finance their debts, to stimulate the economy, to spend on various government programs, to hopefully kickstart things, right? Now, of course, we all know that the government, albeit I think all of us have different degrees of opinions on how the government does its job, I think most of us would agree that the government doesn't do a very good job of that. And you can see the economy has still not really gotten to a good state, at least helping the average everyday person, right? Well, unfortunately, we've gone through this experiment for far too long. In this case, the Federal Reserve has stimulated the bond market, one of the best bond markets in decades, and now it is about to face the consequences because it's going to have to reverse its trend. Now, again, I want you guys to stick with me here. I'm going to talk about how this relates to crypto here in just a moment, but we need to first understand what the Federal Reserve is doing in regards to these much larger markets, okay? So the Federal Reserve realized, and again, as we've talked about time and time again on this channel, the Fed has said one thing and done another time and time again. They have said for the last few years in this case, especially since the pandemic, that the inflation we're seeing in the economy from all this excessive money printing that we've conducted, it's transitory, it's temporary, it is a sign of the times that is going to pass as time progresses. And we all knew, I think any of us knew, that practically increasing the base money supply in a matter of a year to two by 40% was going to lead to inflation. That this was a complete BS claim from Jay Powell and the rest of the Federal Reserve. They were trying to save face, trying to buy time and see if they could play this tightrope that they have to play between stimulating financial assets and stimulating the base economy. Unfortunately, that is not the case. Can't have it both ways. And the Federal Reserve is now completely stating it is going to reverse course. Now, I don't know if the Federal Reserve is actually going to do what it says it's going to do. It has a great track record of not actually sticking to the words that it claims that it's going to meet to. But the key thing I want to emphasize here when it comes to understanding where the Fed is going to go long term is following the bond market. It will tell you more than anything what the Federal Reserve is actually going to do. And when we take a look at the, for example, the futures markets to the CME, if you take a look at the next few months, the vast majority of the market here is betting on the Federal Reserve hiking rates. There is no one betting in this case that the Federal Reserve is not going to increase the federal funds rate by 50 basis points or more by May of 2022 in a month's time. In June of 2022, most people are betting the federal funds rate is going to be at accelerated levels compared to where it is, somewhere around 1.5 to 1.75% here, or 150 to 175 basis points. And if you really start to step out into July, you start to see we get up towards 2%. We step into September, we start to see well above 2%. November, we're seeing here in this case, people chartering into near 3% territory, right under around 2.5 to 3%. The majority of people betting the federal funds rate is going to be somewhere in that ballpark. And we are seeing that materialize here within the yields for treasuries. Because as the federal funds rate goes up, the yield on treasuries will follow. That's what we're seeing here within the market. Now again, whether the Fed does that or not, we don't know. But the bond market is speaking volumes. It is telling us what the Federal Reserve is going to do. Sometime here in the future, it is going to have to curb inflation. It is going to have to make up for the major increase in the money supply that it has injected into the economy over the past few years. We can see here, just to again put it in perspective, it's back here in February 2020. In a matter of just over a little over 2 years, the Federal Reserve has injected 40% of all new money over these past 2 years. It really starts to put it into perspective here when you watch the long-term trend line here, just how much the Federal Reserve did in such a short period of time, and it has not stopped as of yet. So now the Fed is going to claim, or at least it is claiming, that it is going to park the brakes. Now, here's the important thing. I know a lot of you are thinking about what this means for crypto. Well, first off, we need to take a look at what this means for equities, the stock market. Because right now, stocks are taking a big hit. And when the bond market starts to go into a downward spiral here, this is usually a sign of a recession around the corner. And a recession is never good for equities. It means limited credit creation with the cost of capital going up over time. It means less bond issuance in this case, less bond purchases for funding government expenditures, right? This is the Fed not coming in as a stimulation tool to keep the economy circulating and going. And therefore, equities are likely going to roll over and pull down in price. We are seeing that here. If you guys want to know my sentiment on this chart here, this is a typical candid dead cat bounce here that is going to roll over and probably continue. The Federal Reserve might not be playing around this time. It might be in a pickle where it has to put the economy into a recession. because of the last few decades of poor monetary policy decisions. But all the while, this might lead towards equities selling off, which have been, bear in mind, heavily stimulated from quantitative easing. There might be a dark horse. While property markets, again, stimulated by the Fed, have gone up in value continuously, while the equity markets have continued to climb up over the long period of time and are now finally starting to pull back like properties and like most assets, I want to point your attention to a very important ratio we've talked about a lot here on the channel. This is a chart that I feel practically no one is talking about in the space right now. And that is Bitcoin divided by any of the major indices, from the NASDAQ to the S&P 500. Take a look at this chart here. Now, you all would probably assume, and I honestly would probably be in the same ballpark with all of you in this case, that if we're in a bull market for assets, if equities are ripping higher, if the Fed is engaging in quantitative easing, making funny money flow into the economy, you would expect that not only equities would go up, stocks in this case, but that crypto would probably accelerate beyond that it would do 2 or 3x what equities are doing, as it's a more niche, smaller asset class, it has more room for growth multiples, and it is a new emerging asset class, and vice versa. Because it's seen as this more kind of high-risk asset, at least in most people's perception, if equities were to pull back, if the Fed engaged in quantitative tightening, we should expect crypto to sell off 2 or 3 times harder. That we should start seeing it break down in the ratio against equities. It should be underperforming equities, but it's not doing this. Take a look at the chart here. Since back here in December of 2020, the ratio has continuously made healthy highs each and every time. To put this into perspective, from the previous low here back in November, December to the new low, there's a 48% increase in the ratio. Bitcoin outpaced equities by 48%. Now, they could be both going down in that period of time. I'm not going to stretch on that truth. That's important to note. They could still both be going down, but it is outperforming equities by 48%, meaning that equities may be selling off or not holding up 48% better than crypto. Take a look here from this low here, 27% increase in just a matter a little under half a year here. And we are seeing this trend not materialize just over the long-term trend, but continuously. In fact, we're starting to break away from the support line here upwards. Even as equities are in an absolute panic mode, Bitcoin's price is holding up quite nicely. We are making higher lows here in price and slightly higher highs here over the short term since the start of the year. Now that is really interesting. That is something that cannot be ignored. And again, bear in mind, that's against the NASDAQ. We can take a look here again to get a more balanced view here. Let's take a look at the S&P 500, right? We can do the same here with the ratio. Divide Bitcoin by SPX, and look at that. You get the exact same trend here. Higher lows over time. We are building a seismic wedge here for crypto to prove itself and detach itself from the high correlation it's had with equities here in the short term. To give it a chance to not only rally heavily here and possibly at least just hold out during an equity sell-off, but eventually break out above this range and start to trend much higher, as it has historically done against equities over the long run. And that's the important thing I want to bring to your attention here, that even though there's been a correlation with equities, that people see crypto still as a risk-on asset, Bitcoin and Ethereum are non-correlated assets. They are not tied to the sovereignty of any nation. They're not tied to, per se, I'm trying to think of the proper term here. They're not tied to the financial solvency of a nation state. And when there are massive outflows of money from usually defensive assets, like U.S. Treasuries, that money has to go somewhere. That pressure to fight against inflation needs to go to another asset class. And I'll be honest, I don't think all of it's going to crypto, nor will all of it go throughout this potential next wave in crypto markets. But we are clearly seeing, whether it be in Bitcoin or Ethereum here, that in these ratios of Ethereum or Bitcoin against the S&P 500 and the NASDAQ, that there is more buy-side pressure in crypto. We are not seeing people flood out of the market, essentially. We are seeing more confidence come into crypto markets. I think that the demand for a hedge against inflation that treasuries used to maintain and hold are going to flow out into the crypto market. And it's not just my thoughts. at the end of the day. It is what price is showing us. We should not see crypto hold up as well as it is right now in this kind of macro environment, with this kind of sentiment in equities, with the Federal Reserve's moves. We're not seeing it. And on top of that, I want to go ahead and show you one last thing here that proves to our point here, that showcases just how strong and resilient the buyers are coming in here. While the market may not be rallying high in this case when it comes to Bitcoin or Ethereum's price, I want to go ahead and show you all the chart you all need to see. It's right here on the right hand side on our tool we use here on the channel, and that is Bookmap. Now, Bookmap gives us market insight data here to where the market stands here. And I want you to take a look here. We're taking a look at the Coinbase feed here and look at the asks on the order book, people who are waiting to sell their Bitcoin at a higher price for the next $10,000 potential price movement, and also the next $10,000 in potential sell side. Look at how many bids there are on the order book for Coinbase versus the asks. Potential buyers coming in at a discount versus potential sellers at a heightened price. Now, I understand the order book can't be taken at absolute face value. Sometimes things can move on the order book. Sometimes people can adjust their positions. But the sheer difference between buy-side pressure on the order book, potential support for those who might want to sell or market order sell, versus those who want to sell their Bitcoin at a higher price, is absolutely dramatic. It shows us here that people are silently trying to fill massive order sizes here for crypto assets during this low period of time and price, this discount, before prices start to get higher, before the market gets wiser and people start not filling in limit orders or bids, but start market order buying any potential Bitcoin. I promise you all here, if I'm taking a look at this order book here, I'm getting the feeling that something exciting is around the corner here. And you can continue to stretch this to see this in a more exaggerated way. As we move up here, there aren't many Bitcoin being sold at these higher price ranges. There aren't many people in the market who are looking to sell their Bitcoin. And the more and more there is this fear in the bond market and a need to flow liquidity across the globe into new asset classes, the higher and faster price is going to accelerate. This is not a time to fear cryptocurrencies. It is a time to embrace them. So, anyways, guys, I've rambled on a good amount here. I want to go ahead and, if you all enjoyed this conversation, ask if you could give a like. But let's go ahead and dive into one of the most exciting protocols that I'm watching in the cryptocurrency space. It's one that I'm not only personally exposed to in my investment portfolio, but I think is one that you guys should definitely watch if you're bullish on Ethereum, as well as other alternative layer 1 protocols in the crypto space. Let's go ahead and dive into our sponsored review of Radix. Alrighty, everyone. So to kick things off here, I want to spend some time to talk about Radix and what it first stands for here as a protocol. For those of you who may not know what Radix is all about, Radix is aiming to radically change the way that decentralized finance is done. It aims to allow individuals to develop smart contract applications, or dApps, or decentralized applications, on its distributed ledger technology in a much more streamlined way through the novel invention of Scripto, an implementation of the Rust language framework. Now, if you all know, in regards to smart contract development or decentralized applications, all the problems that can occur, from faulty code that leads towards hacks and exploits, from the long time it takes to develop within the Ethereum ecosystem through the Solidity language framework, and all the other kinds of issues that can arise from high gas fees and lack of scalability, you all know that there is a need for an alternative layer 1 blockchain protocol. And that's exactly what Radix is aiming to offer here. It is aiming to radically do what no blockchain layer 1 has done before, and offer the ability to build decentralized DeFi applications or decentralized finance applications in a whole new way. Say that 10 times fast. Now, I want to go ahead and talk about why I'm personally really excited about Radix. While a lot of the other layer 1 blockchain protocols kind of take a faster approach to getting to market, and that is usually through being EVM compatible or compatible with the Ethereum virtual machine, Radix is doing something that's more of a long-term bet and could radically change the way that people go about building things. Now, if you think about a network like Avalanche, for example, usually you can deploy already existing Ethereum applications onto the network, and that's fine and dandy. But the problem is that it comes with the same smart contract exploits, and same kind of bugs and errors that can come from developing on Ethereum. So it doesn't actually really do too much in the sense of fixing things. Sure, it might have a new scaling mechanism or consensus mechanism, but it is likely the same way in the sense that how you interact with tokens and interact with decentralized applications. Well, Radix is changing that in a dramatic way with its implementation of Scripto. Now, there are some big updates here to talk about. Again, I recommend that if you guys are interested to dive through the papers here, there's a lot of really interesting ones talking about the economics of Radix, how Radix on a macro scale is aiming to change DeFi and bring it to the multi-trillion-dollar opportunity that it can be, and also a lot of documentation around cross-shard consensus, how they can scale long-term, and also how consensus is met on the network through Cerberus. But I want to go ahead and talk about some of the big updates here today, as many of you are likely already familiar with Radix and what makes it valuable. First off, the Babylon rollout update that came out back a little over a month ago here is a really important read if you guys haven't checked it out yet. It talks about how the next major network update for Radix is going to come out in multiple phases. Now, a lot of blockchain protocols usually try to do everything at once, and they try to get things out ASAP. And the unfortunate thing about that is that they're building things as if they're building some software company versus building a foundational protocol where financial applications, money, and transaction data is going to be interacting on top of. And it's an important thing to note that this is not some kind of game that you play around with and you try to deploy things out in a rapid fashion. In this case, Radix has taken a different approach that is much more healthy, in my opinion. One that is slow, steady, and eventually will win the race in the long run. Babylon is going to be broken out into multiple phases here. Now, you guys can read through the article here, but I want to talk about the 4 major phases here. The first one is the public test environment. This is going to allow for initial testing here for Babylon and allow people to actually start to deploy full stack development applications and also basically build out the front-end applications and start to test them. We also have the AlphaNet, which is going to be the first major test environment here with core network and gateway functions for actual testing. You're going to get to phase out more and more functionality here of what it's going to look like interacting with the Radix blockchain. But what really gets exciting here as we go throughout the coming months, coming quarters, is that as we go into the close of the year here, Babylon BetaNet is aiming to go live with APIs and finalized Scripto and network features that will allow for production testing begin for Scripto decentralized applications and migration of third-party integrations. And finally, in Q1 of 2023, a little under a year from now, they're expecting to launch the public network migration, where Babylon is not only going to be officially complete, but the Radix mainnet is going to have full Scripto functionality. Just as if how you have with Ethereum, where you can build and Solidity build applications. But this is going to come with all the scalability and developer time, lowering the amount of code required and complexity developing decentralized applications. And on top of that as well, having a high degree of security, being an asset-oriented language. Now, again, I don't have all the time to dive in through here why it's important to be an asset-oriented language, but it allows to remove the ability to remove all these problems that can come building applications, or DApps in this case, in language frameworks like Solidity. So there's a lot of exciting stuff. I recommend you guys dive into it. Some really important accolades to talk about. Back here in the early part of the month here, they had the Scripto developer event in Lisbon. Not only had a great turnout from people in the Lisbon community, but on top of that, started to showcase a lot of wide ranges of applications people could build and some use cases of how this asset-oriented language framework helps Scripto to stand out on the grand scheme of things. Not just copying the EVM framework that a lot of blockchains can easily go out and do today. Building something from scratch, doing something novel, and helping to actually build a foundation that can fix the problems. One in which that was actually built around the complexities and frustrations of development on the Ethereum blockchain. And I say that as a big fan of Ethereum. I think Ethereum's a great network, but it comes with a lot of issues, being one of the first ones in the race. So that's one big piece of news. On top of that as well, if you guys haven't heard already, Staking Rewards, major staking platform here in the crypto space, has now integrated Radix. And one important thing to keep in mind here is that for Radix, there is still a relatively low degree of participation here with a high reward ratio for those who are staking their Radix tokens. I'm guilty in this case, being in the United States, holding EXRD and stuff. I'm not staking at the moment. So if you guys are abroad in this case, you want to stake Radix, if you like it long term, there's some really good staking rewards in this case. Just want to bring that to your guys' attention and you guys again can check out online how to get involved in Radix staking. There's a lot of resources on their official website. And one really big thing here is the recent update and feature with Dan Hughes, who's the founder of the RDX Works Network, in this case the foundation that's been building Radix. He's got recently featured in the Washington Post talking about his thoughts within Web3. Dan is an incredibly interesting guy. He's a true engineer at heart. If you guys have watched any of his live streams, any of the videos that he's done where he's done all kinds of crazy things like storing high complex videos onto the Radix network, or for example, building a duplication of Twitter on top of the Radix network, showcasing the high throughput and scalability, as well as the amount of data complexity that can be stored on this scalable network. I highly recommend you guys check into it. He's done some really fascinating stuff, and I think his thoughts shared here in the article are quite solid as well about whether or not Web3 will ever go mainstream. Now, if you guys are interested in getting involved with the Radix network, you can definitely check out the links down below in the description to their Telegram, where they've got over nearly 20,000 members, all organic, genuine people coming into the space here. I think on top of that as well, you guys can check out the Discord. We've got around 16,000 members. And what I love about Radix is that unlike a lot of the protocols out there that are kind of tossing around shiny bells and whistles and making bloated promises, in my opinion, about what they're capable of doing, Radix is taking a slow and steady approach. They're not focused on hype marketing. They're focused on building an organic community over the long run. And we have a lot of people, from those of you watching the DataDash channel to those of you in the Dash Report discussion group, who are big fans of the Radix network. It's, again, not something that I can make any heightened promises of here in the short term. And the roadmap doesn't speak to that. It speaks to a nice long-term development of a network that's going to be sustainable over the long run. And that's what I personally like here. I want to see people building things that are going to be impactful for the next 3 or 5 years. And who knows when that value is going to be realized by the broader market. Only time will tell. But that being said, everyone, I've rambled on long enough. If you guys are interested to learn more about Radix, check out the links down below in the description. But I thank you all for always watching my content here on this channel and listening to me ramble. If you liked the video, consider dropping a like, consider subscribing and hitting that bell icon so you don't miss another video here on the channel. But until the next one, I'll see you all in the next video. Take care, everyone.